Hey, what's going on, y'all? Steve Peterson with Infinity Investments, and happy Thanksgiving. It's Thanksgiving week, November 2020. It has been a year, and so, but yeah, it's always a good time to figure out what you're thankful for. So I want to, start this video out with the spirit of gratitude. I am grateful to be on, to making videos and be engaging with y'all. What are you thankful for this year? It's been crazy, but I guarantee you it's one thing you can figure that out. Now, what we're going to talk about in this video is avoiding 3 major mistakes when buying multifamily property. And I think that these mistakes occur whether the market's up, down, sideways, whatever. But you really want to pay attention as we're in a interesting time. And if you're buying, you really want to avoid these 3 mistakes. Number 1, miscalculating the numbers, particularly operating expenses, right? Operating expenses. This is the biggest thing that I see. That's why I put so many videos out on property analysis and the importance of property analysis and understanding cap rate, cash on cash return, internal rates of return. That's all important. But when you're doing your analysis of numbers, the biggest thing that I see even professional investors mess up on is accurately calculating the operating expenses. And the biggest one of the operating expenses that I see is property taxes. All right, property taxes, because it's going to change when you acquire the property for sure. And a lot of times people do, because we want to look at the profit and loss statement. We want to analyze the actual taxes and the actual expenses from the last couple of years. So what we do, we look at the P&L, we take the number for property taxes, and we stick that in our pro forma, our projection for the next year. The problem with that is the number may change. The number is going to change. So what's a better formula is to look up the actual tax bill in the county, which we all have access, no matter what county in the country. You can look up a property-specific tax bill, certainly anywhere in California. And you can look at what the exact, not the estimated, the exact property tax rate is and what all of the special assessments are. And that's where people get lost, because if you do know the tax rate, people just typically apply the tax rate to the purchase price and say, we're done. But we got these things called special assessments, all the bond measures and all that stuff, all the stuff we get to vote for that affects your property taxes. So you can figure out to the dollar pretty much what you're going to be paying in property taxes based on looking it up, the parcel tax information, seeing the tax rate, seeing the exact amount of the special assessments, applying that tax rate to the purchase price, and adding all those special assessments. Now, every year there's some sort of measure that may get passed, things change, but we're just talking about upon acquisition, avoiding this major mistake when you're acquiring property. Now, there's other mistakes too, such as property management, figuring out the property. A lot of people say, we don't need a property manager. We're just going to manage this property but you need that property. 9 times out of 10, you probably need a property manager, unless you're a professional in the business and you got the time and attention. If you're in the state of California, I do believe you need a property manager. There's too many laws to stay on top of. But a lot of times people won't put that number in their expenses. That's crazy. You got to put that in there. Even if you're going to self-manage, put it in there, because the bank's going to put it in there. And if you are going to self-manage, well, then charge the property for your time and effort. Put that in a separate account. A lot of times owners just out as a self-management, but the problem is not putting that number in your expense does not really help you out. The bank is going to account for that in their underwriting. Another investor, if you're selling the property, they're going to account for that. So you're not really making the numbers better by not having a property management expense there. So just take that with a grain of salt, but you have to always budget for it. Repairs are probably the biggest thing that is that's the biggest thing that's really unknown. What we can do is, in our analysis, look at what are the work orders that were done at the property over the last year. Okay, if it's a high number, I guarantee you the seller's broker, the seller is going to say, well, we had to, it was an unusual year. We had to do a bunch of extra work, and therefore that's why the work orders are so high. But if you ask for all the work orders that were done and completed at the property, you can get a real good idea of not only the cost that was done, what was done to the property, and you can spot out reoccurring issues. On one property, give you an example. One property we were working on had a bunch of different multiple buildings, and we kept seeing toilets getting replaced. And so when it was 16 different buildings and 7 of them are getting replaced, we know there's some problems there. All right, by analyzing the work orders, you can get a good idea of what's wrong with the property, what's been fixed with the property, and what they're spending on the property. So make sure you analyze the work orders. Also, you want to look at any service contracts. If you have a vendor doing your landscaping, if you got a vendor doing your pest control, look at those actual contracts, see if they can be negotiated. You always want to try to negotiate and figure out what you can do to minimize those expenses. All right. And I'm giving you the main things that I see, and because as we're going through this pandemic, you really got to be dialed into your analysis of these properties. It's very important. Even if in a great market, when everything is great, you still got to be dialed into that, and you want to avoid the number one mistake of underestimating your operating expenses. All right. So do not underestimate your operating expense. Number one. All right. Number two, the second biggest mistake that I see in buying multifamily properties is basically over leveraging the property. Now, I think in today's environment, the bank is not going to let you do that. But so that's the one thing about a difficult financing market is that the bank's not going to let you over lever your property. Meaning that when I say over lever, or put over leverage, that means that you're putting so much of a loan amount and so much of an annual debt service that you're squeezing the cash flow. You're squeezing every penny out of the cash flow so that if one or two things go wrong, you're negative cash flow, right? Now, in a good market, like we've seen over the last few years, things loosen up, debt coverage ratios come down, lenders a little bit more confident. Investors are trying to typically squeeze every penny they can out of it. So I've seen over the last couple of years high leverage deals, getting done. And so I think in the old market, when the Great Recession happened, most of the heartburn was from over leverage. If the property was properly leveraged, you were able to weather the storm, get through the bad economy, keep your rents going, and then rents really blew up and exploded. But a lot of the people got into trouble with buildings is that the leverage was too high. Okay, here in California, this is particularly important because we are in a very, very low cap rate environment. Whether it's the Bay Area, Southern California, Sacramento, Central Valley, the caps are low, so the numbers are thin. So you want to use the appropriate amount of leverage. Most lenders in this market are 65% loan to value. Maybe 70. Okay, a lot of deals have been getting done 75 on agency debt, meaning like Fannie Mae, Freddie Mac. You can even get up to 80%. This is the thing. What I would say though, consider if there's some turmoil in the economy. Consider if tenants are not able to pay. Can you make money on this property? Can you break even? Can you make money in this property if something goes wrong? And consider the cost. It might be better for you to buy $1.5 million property with 65% leverage than to buy a $2 million property with 75% leverage. That means maybe less a property, but it might mean more cash flow. I think that's going to be very important going into this next economy in 2021. All right, so don't over leverage your property. Now, the second piece about that is in the refinance. Everybody's refinancing right now because the interest rates are low. So I want to encourage you in terms of doing that. However, don't over leverage it. All right, that's just my main message. A lot of people want to pull out some money to have some cash on the sidelines. You can do that. Just don't over lever the property. Make sure that you're able to, and I would like to say, make money if the economy goes around and got a couple people not paying. Not just break even, because if you plan to break even, that means you're planning to take a loss at the end of the day. So plan that, hey, if there's something goes wrong with this property, can we still make money in this time? Very, very important, you know? So avoid that mistake of over leveraging your property, because if you do, it's going to be tough to make it through a downtime. And we have to be prepared for that. I like to keep things positive, but I think that if you're prepared for something and it doesn't happen, you're in a better position. If you're prepared for something and it does happen, then you are in a great position, you know, because you prepared for it. And, you know, hey, it beats the alternative every single day of the week. Now, the third thing I want to talk about in terms of avoiding a crucial mistake you want to avoid in purchasing a multifamily property. Now, we talked about underestimating expenses. We talked about over leveraging the property. Now, I want to talk about being overly optimistic. So the third mistake you want to avoid is don't be overly optimistic. This is what I mean. People get a property and they think, first of all, I'm going to manage this property better. I'm going to come in here, wave a magic wand, and I'm going to get these rents from $800 to $200,000. Now, of course, in the Bay Area, we have rent control, so you should know that. All right, but actually, throughout the whole state, there's an element of state rent control. So when you're talking about raising rents, you have to be in compliance. But I'm not really talking about compliance. I'm talking about market conditions, what you can do. Now, when we're looking at buildings, we always want to look at value added. Where can we add the value, right? Where can we get the rents up? Where can we get the expenses down? That's what you need to be looking at. But you got to dial it back, okay? If you do your rental analysis, you survey other buildings in the area, and you determine the market rents are $1,100, you should be budgeting $1,050, $1,075. Now, maybe in actuality, you can go out there and get $1,100, or maybe you can go out there and get $1,150. Budget for $1,050, budget to $1,075. That way, you can insulate yourself in case there's a little bit of a drop. And in case you didn't notice, in San Francisco and in Oakland, rents have dropped. San Francisco so much as 20-25%. Oakland, it's a mixed bag. Depends on where you're at and, all that type of things. Section 8 is still paying market rent and or above. So it really kind of depends. But the bottom line is don't overestimate. Don't be overly optimistic, okay? As entrepreneurs, that's kind of something that we have to battle with, because we always believe that we can get this done. We can make this happen. And that's part of the entrepreneur spirit. But you got to put your investor hat on at this stage. And the investor hat is a little bit more, I don't want to say pessimistic, but a little bit more discerning, a little bit more skeptical, all right? So what I'm saying that is because I see I'm talking to a lot of people, and they're saying, hey, well, I'm going to get this, 1,100 unit rent out for $1,200. We're going to make the cabinets look real nice, and we're going to get $1,200. It's great if you can get that $1,200. Don't budget for that $1,200. Don't be overly optimistic. That's all I'm saying. Keep a positive mental attitude. Be a problem solver. Be aggressive in your approach to try to be the best that you can be. But let's not be over optimistic in a shifting environment. Okay, so those are the 3 mistakes I want you to avoid. All right, make sure that as we're going forward, I did a video last week about, is it time to buy? I think it's always time to buy if you have a great strategy, great plan, and you identify a great deal. But the biggest thing is, when we talk about identifying a great deal, is in your analysis, you want to follow this advice and don't get, caught up with underestimating expenses. Do not get caught up in that. Do not get caught up in over leveraging your property, and do not get caught up in being overly optimistic. Keep it real with yourself. Have your plan of action, but dial it back to be prepared so you can win when everybody else might be, not in the best position. Hope this helps. Like this video. If it does, please subscribe to this YouTube station and stay tapped in with our content. Again, happy Thanksgiving, November 2020, to you and your family. Peace out.